Here is the strange reality this morning. UK inflation has just hit a 4-month high, yet the pound is almost flat. Official figures on Wednesday the 19th of August, 2026 showed annual CPI inflation rose to 2.9% in July, matching market forecasts exactly. The immediate market reaction was incredibly calm. Sterling ticked up just 0.08% against the US dollar, while the euro trimmed earlier gains against the pound. That muted move is not because inflation suddenly stopped mattering. It is because the print was fully priced in, and traders are already focused on a more dangerous story underneath the surface. To understand why the pound shrugged, you have to separate what is temporary from what is structural. The rise to 2.9% was driven mainly by energy. Rebounding household energy bills and higher oil prices pushed the headline rate back to its strongest level in 4 months. But core inflation, which strips out volatile food and energy costs, was expected to cool slightly. That matters because it tells the Bank of England that domestic price pressure is not broadly accelerating. At the same time, recent labor market data has been cooling. Softer hiring and weaker wage momentum shift the central bank's focus away from red-hot demand and toward a much more awkward problem. The International Monetary Fund has warned that Britain faces slower economic growth and more persistent inflation than any other major economy next year. For households, the jump in headline inflation is not abstract. Higher energy bills feed directly into weekly budgets, and with CPI climbing back toward 3%, the cost of living squeeze is returning. For markets, however, the pound's lack of reaction reveals how expectations have changed. Gilt yields have been reflecting stagflation fears, meaning inflation around 3 or even 4% combined with weak growth. If the economy is slowing while prices stay sticky, the Bank of England cannot cut rates aggressively to help growth, but it also has little appetite to hike further. That leaves sterling trapped in a narrow range with no clear catalyst today. The pound was also restrained against the Japanese yen, showing that this was a broad absence of surprise rather than a dollar story. Looking ahead, the evidence suggests headline inflation still has room to climb. Several forecasters expect it to drift towards 3.5% later this year as energy base effects continue to feed through. However, markets see little reason for the Bank of England to raise rates through 2026. That means the real return investors receive after inflation may stay compressed, which is a structural headwind for sterling. The pound's next decisive move will probably be determined by core CPI and labor market figures, not by energy-driven headline swings. If core prices remain sticky while employment cools further, the stagflation warning grows louder and the pound could face renewed downward pressure against the dollar and the euro. So the real story this morning is not simply that inflation hit 2.9%. It is that sterling barely blinked because the number was widely expected. The genuine risk now is the combination of sluggish growth and sticky prices, a scenario the IMF has explicitly highlighted for Britain. For traders and savers, the practical lesson is to watch next month's core inflation and wage data far more closely than the headline rate. Until then, expect the pound to trade on Bank of England policy speculation rather than on today's well-telegraphed inflation print.